What do hotels, airlines, retirement and your 1 crore have in common? They all make or break your financial future. This week on Learning Saturday, we have 3 high-impact webinars. First step, Decoding India's Hotel and Airline Industry. A deep dive into industry dynamics, post-pandemic shifts, regulations and Indigo versus peers. Led by Krishn Bhaiya at 11 a.m. And we also have a Kodishwari webinar, Beyond Gold and FDs, a smarter take on retirement planning for modern women. This is exclusively women-only webinar to move beyond traditional savings to build confidence, independence and long-term security with Aishwarya, Mahesh and myself at 11 a.m. At 6 p.m. in the evening, we have Accelerate Your Wealth to 1 crore, a strategy-led session on how discipline and structured investment can systematically take you to 1 crore milestone by Mr. Shyam Sekhar. This Learning Saturday, don't consume just content, upgrade your thinking. Link in the description, register now.
COVID has definitely changed one thing forever. That is the fund manager's job. COVID has actually created an explosion in investing. It has created numerically a far larger investment community. It has also provided a very large pool of capital chasing investment opportunities. The size of mutual fund schemes, portfolio management schemes, individual investors' portfolios, everything has gone up multifold. In the process, there is a peculiar problem today which a portfolio manager faces. An individual investor probably does not need to face these problems. The portfolio manager has to deploy the capital which is given to him. He cannot turn away capital. At the same time, he cannot deploy it wrongly. What has happened in these 2 years is that managers have been forced to deploy capital in the wrong parts of the market. Because liquidity is a very important consideration in decision making for a portfolio manager. You all know that there is a metric which he has to give out, which is if he has to liquidate the portfolio, how long it will take. And that is based on the recent history of trading volumes in a stock. So he cannot buy an undervalued stock if it is illiquid. So he has to always invest only within liquid stocks. This is the core problem that I believe a portfolio manager faces. When you have to invest only in liquid stocks, then you are always going to look at stocks which are already discovered, often very well discovered. And when you are doing that, you are not going to get them at valuations which are attractive. So essentially, you are going to buy companies at valuations which are not so attractive and hope that they still perform for you. This has happened all the more in the mid-cap, small-cap and micro-cap space, where progressively liquidity goes down. And when liquidity goes down and you have to put more capital in the place with lesser liquidity, then you are compelled to buy more liquid stocks. You have seen 2025 attract so much capital in small cap mutual funds. You have seen so much capital go into a micro cap index. All this has distorted investment behavior so much that managers are becoming victims of their own compulsions. Deployment is almost always a problem when it becomes a compulsion. When you are compelled to deploy, you are not going to deploy correctly. This is where the managers who have a right to deploy in illiquid stocks and who have the buy-in of investors who are willing to wait for, let's say, 2-3 years before those illiquid stocks become fancied by the market and become very, very liquid in the process. When a stock is fancied by the market, the liquidity automatically increases. I'll give you an example. There are many companies which are today trading at 10,000, 15,000, 20,000 crores, which I bought when they were 200 crores. At 200 crores, for me to buy 2 crores worth of stock took me weeks, often months. They were extremely illiquid. I had to be extremely tight-lipped about my buying. You cannot mention the name anywhere. And that actually continues to this day in buying illiquid stocks. But that's not the story. The story is once the stock becomes discovered and it goes to 5,000 crores market cap, the liquidity rises exponentially. At that time, it becomes institution ownership worthy, which means the mutual fund can buy it, the PMS can buy it, hedge funds can buy it, AIFs can buy it, everybody can buy it. Finally, even an LIC will start buying it. So, this progression from an illiquid stock to finally an LIC owned stock is a journey where the valuation becomes less attractive as each category of people start owning the stock. You can rest assured that by the time the insurance companies come in, it's probably expensive. And they don't mind coming in even at expensive valuations because their return expectations are probably lower than what the PMS manager expects or a mutual fund manager has to deliver. So the problem which fund managers face today is that they cannot buy illiquid stocks. They have to buy stocks as they turn liquid. And they must be careful not to buy a stock which turns liquid without being supported by a fundamental improvement in business potential and performance. Stocks can turn liquid because of market forces. A portfolio manager has to be sure that it's not market forces that is creating this liquidity, but a general interest in the stock which is backed by a steady, decisive improvement in the fundamentals of the business. To be honest, 2025 did not have too many stocks like this. But here's the good news. As we speak, we are seeing more stocks turn attractive and more liquid stocks turn attractive. That's a very, very important factor. As more and more liquid stocks turn attractive, you get a chance to buy them. So within your own ownership universe of stocks, you have to get out of a liquid stock which does not have as attractive prospects as another company which is coming under your radar, which you find very attractive and is also liquid. So you have to do this lateral switch. Alternately, you need to convince your investors to give you more capital so that you buy these new ideas without a compulsion to sell your old idea. Now here is the other problem which a manager faces. The manager has to go by recency of performance. You take a small cap fund. Last 1 year has not been great. Probably the last 10 days has been even more painful. At this point, how does he convince an investor to give him money to invest in something new he is going to find? This problem is all the more accentuated for the PMS managers because most PMSs focusing on small caps are actually benchmarked against either the BSE 500 or NSE 500, which are hardly small cap in character compared to their portfolio, but that's a reality people have to live with. So the investor has to be made to understand that his portfolio is very different from the benchmark. It is aiming to go into a very different direction and still deliver performance over the next few years. So it's not really a problem of creating returns from new opportunities. It's a problem of convincing the investor that the road to those returns is through a different path and not the usual path of buying liquid stocks. If somebody has already bought very liquid stocks at slightly elevated valuation and they are not doing well, he has to now answer for those decisions and he cannot actually take these decisions which he is now seeing in front of him as opportunities to the investor. But that's the nature of the job. If we are signed up to be an investment manager, we have to face all these things. We have to overcome these things. We have to constantly work with investors, convince the investors of what is in their interest. And it is our job to take the extra effort to convince the investor because investors generally are heavily biased by recency of returns. And that's a reality we all have to learn to live with. But the good part is the investors who actually get convinced easily or who are more objective in their approach to developing that conviction tend to come back faster in their portfolios. They actually make higher returns long term and their compounding is far higher. It is these investors that a manager should actually focus upon and work for. Because if somebody does not want to build conviction, however hard we try, you cannot build conviction. Whether that person is managing his own money or he has given it to a manager hardly makes a difference because the effort to develop that conviction either in one's own investment thinking or in a manager's thinking has to be made principally by the investor. Whatever effort externally is done to convince him will not succeed unless the investor decides to make the effort to build his own conviction. And that, in my view, is the biggest problem fund managers face today and will continue to face through 2026. Thank you for watching this video.